So end year adjustments, and those adjustments that we are going to make on the trial balance figures, so that now we can be able to get the correct balance to be used in preparing the income statement. And then some of these adjustments also will be incorporated when we prepare what we call the statement of financial position or the balance sheet. So basically, the end year adjustments are those additional information that we are going to consider in any question, and then we incorporate them together with the balances we have in the trial balance, so that now we can be able to prepare the final statements. So in our discussion, the end year adjustment will involve, number one, what we call the accruals and prepayments. We shall start by that, the accruals and prepayments. If I can start with the accruals. An accrued amount is an amount which has not yet been received if it is an income, or paid if it is an expense by the end of the financial year. So it is an amount that we are supposed to have paid or received, but when we end a financial year, that amount has not yet been received or paid. So any amount of that particular nature is normally considered to be an accrual. So in this case, we'll find also the terms like due being used, outstanding, owing, arrears, unpaid, or not paid. When all these terms are used, or anyone is used, we are simply talking about an accrual. An accrual is an amount which is supposed to have been paid, but by the end of the financial year, that amount has not yet been paid. If, for example, our financial year ends on 31st of December, in most cases, you'll find that the salaries and wages for the employees in that particular month of December will be paid in early January. So when the year is coming to an end, or it has come to an end, but a certain expense for the year that has already, or is coming to an end, has not yet been paid or received, it is going to be considered an accrual. So that salary, the moment we go to 1st of January the next year, then we consider that salary as an accrued salary, because it belongs to the financial year which has already gone. So after having said that, I want to say that when it comes to accrual, we have what we call accrued expenses. When we talk about accrued expenses, these are expenses which have not yet been paid by the end of the financial year. So when we are ending, it has not been paid. And remember, an expense is simply a cost to the organization. So that cost which have not been cleared by the start of the next financial year, it is considered as an accrued expense. So this expense is normally added. We normally add to the expense amount. We normally add to the expense amount in expense amount on the trial balance. So there is an amount that will be given regarding this particular expense in the trial balance. So this accrued amount will be added to the amount that is in the trial balance, so that we can be able to find the total amount that was payable. Remember, the financial statements are supposed to be prepared on the basis of accrual. And accrual concept simply says that in any financial year, we need to consider the costs or the expenses for that period, whether paid or not. If it belongs to that period, even if it has not been paid, we need to consider that amount or that expense in that particular financial period in which it was incurred. So if, for example, it was salaries, in the trial balance, we are given the figure for salary as maybe 25,000. Then we are told that we have got accrued salary of 2,000. So that accrued we normally add to the salary that we have been given of 3,000, so that now we say in that particular financial period, therefore, we were supposed to pay a total of 28,000, and this 28,000 is what we shall use. We shall not use the 25,000 that was given in the trial balance, but we shall use the 28,000, which is the total salaries that were supposed to be paid in that financial year. The accrued expense, is considered as a liability. Is actually a liability, or it is a current liability to be specific. Remember, a liability, it is anything that we owe an outsider or somebody who is not part of the business. So it becomes a liability. It is actually a debt. We owe those employees their money. So you need to consider that. So the two things that you need to understand here or remember, it is normally added to the expense amount that have been given, and then it is considered as a current liability in the other statement, as we are going to demonstrate. Then we also have what we call accrued income. Accrued income is income that we have not yet received by the end of the financial year, but already we have earned that income. So if, for example, we have got rentals somewhere where we normally receive rent from the tenants. So if it is the end of the financial year and there is a tenant who has not paid the rent for December, then that amount is going to be considered as an accrued income. Income not yet received, but it has already been earned, or the time for receiving it has already passed. So the same case will apply. You add to the income amount given, and then you treat it as a current asset. This one is going to be considered as an asset. It is not a liability. A liability is what we owe somebody, but an asset is what we claim. What we claim as a business is an asset. Because this is our money, but we have not received, it is an asset to the business. But accrued expense, it is what we have not paid, so it is a liability to the business. So that is all about the accruals. Accrued, remember, it is not yet paid or not yet received. And then these terms can be used to substitute the word accrued. And then if it is an accrued expense, you add to the expense category, and then the amount that is accrued is a liability to the business. If it is an income, similarly you add, but you treat that accrued income amount as a current asset. Then we can have a discussion on the prepayments. A prepayment, it is an amount which has been paid upfront before the actual time for paying has come. So if, for example, you pay school fees and then you pay it in excess such that it has spilled over to the next semester. This semester, maybe you are supposed to pay 30,000, but you have paid 35,000. The 5,000, which is on top of what you are required to pay, is considered as a prepayment. This amount, it is simply an excess amount, and therefore it is going to be carried over to the next semester. And if we are in the current semester, then that 5,000, you have not received the services for it. So it is your money. So this is what is going to happen when it comes to prepayment. One, if it is a prepaid or prepaid expense, remember, we are the ones who are paying. It is an expense that has been paid in excess. It has been paid before or the date for payment has come. So this one is normally considered as an asset, and actually a current asset to be specific. Because yes, we have paid, but we have paid excess. The excess is still part of our money. Until we receive the services for that particular amount of money, that money is ours. If it is school fees, you can launch a refund from the school and you will be given back your money because it is your money actually. then you need to find that or understand that this amount of money, because it is in excess, to get the correct amount that was payable in a particular financial period, we normally less. We less prepaid. We normally less prepaid amount from the amount given in the trial balance. So if you are told that maybe we paid electricity 10,000, and then down there under the additional information, you are told that electricity that was paid in advance or prepaid was 1,000, then it simply means that in that year we were only supposed to pay 9,000. So we normally come this 1,000 which is prepaid, we less it from the amount paid, so that now we can get the correct figure to be used in the income statement. And then the 1,000 extra which is prepaid, we now consider it as our asset, as a current asset in the other statement we call the statement of financial position. Then we have got what we call prepaid income. First thing, income is what we are supposed to receive. It is money inflow to the business. So if it is a prepaid income, then it simply means that we received in excess. Somebody was supposed to pay us, but yes, he paid, but in excess. So if that person paid in excess, then we actually deduct, we less the prepaid. We less the prepaid income amount. And then this amount which has been considered as prepaid, because it was received in excess, then as a business, we owe the person who paid that money. So if I receive a certain amount of money from you, and I receive it in excess, then the excess amount I'm supposed to refund you. So I owe you. So if I'm the business owner, then you'll find that the business will be having a liability because I owe somebody who paid in excess. The same case, or if I can change the story, if I pay you, but I pay you excess, I was supposed to pay you 5,000, I pay you 5,500. You will be now the one who owe me, the 500 that I paid in excess. So you'll find that now, by paying excess, you or the business now is going to have a liability of refunding the extra amount that was received. So the prepaid income, from that explanation, we can say it is going to be a current liability. It is going to be a current liability because we need to pay that other person who has paid that, who is actually an outsider, the excess that he has paid. So when it comes to prepayment, also known as the paid in advances, you will find that in the income statement we normally less. Even if it is a prepaid expense or a prepaid income, we less. Then that amount, if it is a prepaid expense, it is an asset because we paid in excess, that excess is still ours. But prepaid income, it is a liability because the person who paid us in excess, we are supposed to refund that person, or we owe the person the extra amount that was paid. So that is the details I can give as far as the accruals and prepayments are concerned. If you go to the LMS and year adjustments, we have got full notes on the same. And having explained that, you'll find it is going to be very easy on understanding. Then I will also mention something to do with, that was adjustment number 1, that we shall be coming across accruals and prepayments. Number 2, we shall be coming across what we call bad and doubtful debts. Bad and doubtful debts. A bad debt is actually a debt that has been proved to be unrecoverable. The debt that has been proved to be unrecoverable is normally considered as a bad debt. This one arises as a result of selling goods on credit to your customers. When you sell goods on credit to your customer, you cannot or you may not receive 100% of the money from them when the year ends. Some of them might fail or may fail to pay you. Those who will not pay you, and for sure you know that they will not pay you, we normally call those debts as bad debts written off. We normally write them off. We normally consider them as bad debts written off. Bad debts written off are those debts that you have confirmed. A debtor may fail to pay because one, maybe the debtor has passed on and you have confirmed that. You cannot continue expecting that money to be paid. The most prudent thing to do, you cancel that account of that particular person. Basically, if it was an account for XYZ, who was supposed to pay you maybe 2,000 because of the credit sales that was made to him or her, the moment you confirm that this person is not going to pay you, you normally cancel this account. You don't leave it with this debit balance. You will come here and cancel it by transferring the money to an account we call the bad debt. You write there 2,000. Okay? So that now this one balances 2,000 there, 2,000 there. It has no balance carried down. It has no balance carried down, and that account has been closed. So it has been transferred from this debtor to an account called the bad debt account. The bad debt account is actually an expense account because that is money that you have lost. You will not receive that money anymore. So in the bad debt account, we shall debit that amount that we have transferred from the debtor. So what I want to say is this. Bad debts are those debts that you have proved as the business that they are not going to be recovered anymore because of some reason, one of them being the death of the debtor. Another reason can be the debtor has been declared bankrupt and you cannot maybe force the person to pay, among other reasons. Among other reasons, maybe the debtor was also tricky. You don't know his whereabouts, or her whereabouts it is 9 months down the line, you have never heard about him. You just simply write off that particular account and then you move on. So that now, at the end of the financial year, when you'll be getting the balances of all the debtor, this one is already cancelled. You will not have it incorporated. Then on the other side, if the business has been operational, for quite a long period of time, you can gain experience that a certain amount of money is normally not recovered from the debtors. What we normally call provision, also known as allowance for doubtful. Provision or allowance for doubtful debts. What you'll do, if from my experience, maybe I have been running a business for the last 10 years, and through this experience of 10 years, I've confirmed that at the end of the year, I normally lose maybe 5% of the debtors to bad debts, or 5% of the amount I expect to be paid by the debtors is normally considered as bad debt. So what I will be doing, I will be making a provision. A provision is like to set an amount of money aside. If they don't pay, then this provision or the money that I've set aside will cater for that. So maybe to put it in form of a figure, at the end of the year, I normally lose an average of 5,000. So the most prudent thing to do is to make this provision, to set aside this money, so that at the end of the day, when they don't pay, this provision will cater for that amount that has not been paid. So this one is normally made at the beginning. The provision is normally made because you are estimating. You normally estimate at the beginning of the year, and then the business will run for the whole year, and then at the end you will confirm. You will confirm. Upon confirmation, two things are likely to happen. One, either your provision was more, meaning that you had estimated that you will not receive 5,000 from the debtors, but confirmation you find that what you will not receive is maybe 4,700. So there is what we call decrease. The provision has decreased. You had made a higher provision than the actual. So this 300 is going to be considered as income to the business. When it is a decrease, when you make a higher provision at the beginning, then at the end you find that the provision is more, the actual maybe doubtful debts are less than what you had provided, then the difference is normally an income. A difference is normally an income, and you add this to gross profit. When you witness a decrease, the difference is an income. That income is normally added to the gross profit. The opposite can be true. You can make a provision of 5,000, but at the end of the year, you realize that those who are not going to pay, maybe they are valued at 5,600. So here you had made an under provision. You estimated less than the actual. So there is what we call increase. There is what we call increase in provision for doubtful debts. And the increase will be the difference between what is actual and what you had provided. This increase of 600 will be treated as an expense. Why? Because you go deeper into your pocket. I had made a provision, or I had set 5,000 aside. But at the end of the year, I confirm I'm not going to receive 56. Then it simply means I needed to go somewhere and source for 600 more and come and cater for those provisions. So increase means that the business is losing more. So it is actually an expense and we treat it as such. So here we are going to have two things. The bad debts written off, they have been confirmed. They have been confirmed and those particular debtors have been cancelled from the accounts. But the provision for doubtful debts is an estimate of what might not be received. So you set aside the money. At the end of the day, you compare with what you are not going to receive. If it is an increase, treat the increase as an expense. If it is a decrease, you treat the decrease as income. Last end-year adjustment that we are going to talk about today is depreciation. Depreciation. Depreciation of the fixed or non-current assets. The non-current assets are those assets that are going to remain useful to the business for more than one financial year. They will be there for more than that one financial year. Furniture, motor vehicles, equipments, buildings, land, all those are considered as fixed assets. These assets, as they are used in the business to generate income, they normally undergo a process called depreciation. They lose value. They lose value. The value of that particular motor vehicle at the beginning of the financial year cannot be the same as the value of that asset at the end of the financial year. Obviously, it will have lost value. The difference between the value at the end and the value at the beginning is what we call depreciation. So depreciation is caused by quite a number of factors. Some of them we refer to them as physical factors. Physical factors. These are factors, maybe I can call them caused by nature. Factors that are caused by nature and which will make the asset lose value. And one of them, it can be things like the wear and tear. The wear and tear. As a result of using your asset, it will wear and tear. The other thing is things like the rot stroke decay. Rot or decay, especially for wooden assets. If they are not properly kept and maybe furnished, or they are exposed to rain and all that, they will decay and rot. And as a result of that, you find that their value will be reducing. Then we have other factors like rust. If they are kept, the metallic assets, and then they are exposed outside, they will rust. And as they rust, they lose value. Those are the physical factors. we have the factors we call economic factors. Economic factors, we have things like obsolescence. Obsolescence, it is when the asset becomes outdated. It becomes out of fashion. When new models come into the market, if you had the old version, you find that now the value of that asset will reduce a lot because nobody wants or wishes to buy that. Even if you want to sell it, you'll find that its value is going to be very minimal as a result of that. Then we have another factor associated with the economic known as inadequacy. Inadequacy. When the asset becomes maybe insufficient for the expanded organization. When the organization expands, you find that a certain asset cannot be able to serve it. It is now going to be set aside. It is not useful to the organization because it cannot meet the demand. Then you find that that asset, by the fact that it is now neglected, it is actually losing value. It is of no value to the organization because of its inability to meet the expanded needs of the organization. Then we have other factors like depreciation. Depreciation normally occurs on assets which are which get exhausted. As we use them, they get depleted, like minerals. As we mine, if we have somewhere a mine where we normally get these minerals from, as we go mining them, we are actually depleting them, and actually the value is reducing. So all these are factors that can cause depreciation. But the most important thing is to understand that depreciation, it is the loss in value of an asset. Here, my concern for today would be on the methods of calculating depreciation. For calculating methods for calculating depreciation, we have got two main methods. Yes, we have quite a number of them, but two main methods are the ones that are applicable. And these are the ones that you will be finding in your exam question. Number one is known as the straight line method. Straight line method. This method assumes that the depreciation of an asset remains constant throughout the useful years of the organization. That is to say, if, for example, I have an asset that I bought at 300,000, I use it for 4 years. Then at the end of the 4th year, its value is maybe, let me call it 100,000. So I acquired this asset at a cost. Remember, this cost is the same as the value when I acquired it. After using it for 4 years, it has got this value. The value at the end of the useful life, we normally call this one the scrap or salvage or residue value. The value after the end of the useful years. So you'll find that if it had an initial value of 300,000, but at the end of the useful life of 4 years, it has 100,000, then it has lost 200,000. So the depreciation here would be equal to 200,000. This 200,000 has been lost in a span of 4 years. So we divide by 4. So we can simply say that in each year, this asset was losing 50,000. This is now the depreciation per annum. depreciation per annum is 50,000. So this method assumes that the depreciation of an asset is normally uniform throughout the years it is going to be used. So each year will have a similar or uniform amount of depreciation with the other. And actually, now to put it in form of a formula, under straight line method, depreciation per annum is given by the cost of that asset, you minus what we call the scrap or salvage. Also, you can be told is known as the residue value. Then you divide by what we call the economic or useful life of that asset. Like in our case, the cost of that asset was 300,000. The scrap value was 100,000. Its useful life was 4. So you found, or we found it to be 200,000 divided by 4, and that's where we got 50,000 from. That's where we got 50,000 from. The scrap value, it is the value of the asset after serving this economical useful life. What value remains? That value is the scrap value. So if it had an initial value of this, it is remaining with the value of this. The difference is what it has lost. That difference is now distributed in the years it was useful in that particular business. That is the straight line method. Also, in the questions, the exam questions, you can be told, if it is under straight line method, you can be told depreciation is equal to a certain percentage on cost. When you find that it is on cost, and I insist here, anytime you are given depreciation as a percentage, but you are told it is on cost, then they are simply telling you that the depreciation of that asset is on reducing balance, not reducing, but straight line basis. It is on straight line basis. If it is on cost, because the cost does not change. The cost that you acquired the asset does not change. Therefore, if depreciation is 10% of cost, this year it is going to be 10% of 300,000. Next year it is still going to be 10% of 300,000. It is going to be the same throughout. 10% of 300,000 each and every year. The asset will be useful in the business. So if it is a percentage on cost, it is still straight line. It is still straight line. Then the next method that we shall be coming across commonly is known as the reducing stroke diminishing. The reducing, in other books, they call it as the diminishing. Reducing stroke diminishing balance. Reducing or diminishing balance method. One factor that differentiates these two, the straight line and the reducing balance, is that under the straight line basis, depreciation per year is normally uniform and constant. But under the reducing balance method, just as the word itself, reducing or diminishing, suggests, the depreciation per annum goes on reducing from one year to the next. And the reason as to why is because this one, depreciation, is normally given by a certain percentage that will be given on what we call book value, on book value or net book value. Depreciation is not on cost. This one remains uniform because the depreciation is on cost and the cost is uniform or it's constant. But this one, it is on the net book value. The value of the asset keeps on reducing. If I use it this year, then as I enter the next year, the value would have reduced. As I go to the third year, it is actually going to be reducing. As the years goes by, the value of the asset is reducing, and because depreciation is calculated on the value, then you find that depreciation also will be reducing. So a good example we can say is this. If we have a machine cost is equals to shillings 200,000. Then depreciation is given as 10% on book value. They can tell you 10% on book value or net book value, or 10% on reducing balance basis. It is the same. So if we were to calculate the depreciation here, we can come here and say here, and then the depreciation, and then we can get what we call the net book value. Net book value is simply the cost minus the accumulated depreciation. Let us do it in form of a table. So if we do for year one, what would be the depreciation? Depreciation will be 10 over 100 times 200,000. This one gives us a depreciation of 20,000. At the end of year one, the book value of this particular asset will be 200,000 minus what it has lost. Depreciation is just lost in value. So you'll find that it is remaining with a value of 180,000. So when I calculate the depreciation for year two, I will use 10% of 180,000, 10% of the book value. So you'll find that this one is going to be equal to 18,000. So the net book value here will be 180,000 minus 18,000, which is going to be 162,000. When I go to year three, I do 10% of 162,000. So my depreciation here will be 16,200. My depreciation will be 16,200 for year three. So my net book value would be the value I started with at year three, 162,000 minus 16,200. I get that. And this value is what I will use to calculate the depreciation for year four. So you'll find that as the net book value goes on reducing, the depreciation per year also reduces. And this method, that's why it is known as the reducing balance method. Key thing to note is that depreciation is calculated as a percentage of the book value, not on cost. After having said that, we are through with the end year adjustments. We are through with the end year adjustments. So we are aware when we are given accruals and prepayments, how do we handle them? We are also aware when we are given the bad and the doubtful debts, how we deal with them. We are also aware on how we calculate depreciation using the reducing balance method and the straight line basis. With that now information, we can proceed and go to the topic, which is very, very important for you to note, because this one now is going to dictate whether passing is guaranteed or not. The financial statements. The financial statements of a sole trader. Then from there, we connect with the partnership. Then from the partnership, we do the financial statements of the company, and you will never miss one of them, and they will not come with less than 20 marks. So it is a very, very important area to understand. So, but we cannot be able to prepare the financial statements before we understand the end year adjustments, because always when that question is given in an examination, it will come with additional information. The additional information part entails the adjustments that we have been talking about here. So at this point then, I will just go to financial statements of a sole trader. If time allows, we can do 2 or 3 questions. If you get it right, then that's okay. Financial statements of a sole trader. One, a sole trader is actually a person who owns and manages a business on him or herself. The business belongs to that particular person. He's the manager, and is actually the one who started that particular business. He sourced for capital, started the business, and is purely entitled, or she's purely entitled to the management of that particular business. The business itself that is owned and managed by one person is referred as a sole proprietorship. Sole proprietorship is the business, sole trader is the owner. So in this case, they need to prepare two very commonly prepared financial statements. One is what we call the income statement. They need to prepare what we call the income statement. For those who have been in a business class, even if it is high school, this one is what we used to call the trading profit and loss account. Income statement is the trading profit and loss account. The trading profit, profit and loss account. The purpose of preparing this particular statement is to determine the financial performance of the business in that particular financial year. Remember, financial statements are normally prepared at the end of the financial year. If it is the financial year that was ending that 1st December 2020, we need to evaluate how did we perform in financial year. Here, we only need to know what is the profit that we made, or if things were not okay, how much did we incur as a loss. So that is the sole purpose of preparing this, to understand how we performed in terms of profitability in a particular financial period, which is normally a period of 12 months. So with that, we just go to its format so that you can have it down. The income statement, the format of the income statement. We normally start with the business name. The business name, as you are going to be provided on the question paper, and then you write the income statement for the year. For the year ended. The dates will also be provided in the question paper. For the year ended a certain date. Then from that, we normally require 3, but sometimes we can use 2 columns, but let us have the standard 3 columns for recording the amount. So you need to be careful. These columns, they are supposed to be well drawn, and have them like that, so that when we write here anything, it should not spill over here. We should not have the statements actually obstructing the figures. That column should be very clear from the top to the bottom, and your figures should be well aligned, so that now the marking, or whoever is doing the marking, can find very easy time. Then this is how it flows. We normally start with the sales. Sales, put it on the farmost column. Then from the sales, you less. Sales returns. Remember, sales returns is the same as return inwards. Whichever, some questions they will give you sales returns, others they will give you return inwards. They are one and the same. If you are given that, you less. Then whatever figure you are going to get there, it is what we call the net. The net sales. if I can make an explanation of that, sales, it is the amount of income we received after selling our goods or services, what we received after making the sales. Then, if a customer returns some of the goods that we had sold to him or her, then it's like those goods we have not sold. So basically, if I sell goods of 20,000 to customers, but then a particular customer returns goods worth 1,000. So in short, I have just sold goods worth 19,000. So I normally less what has been returned back, because that item, ideally, it has not been sold. It is going back to the shelf. That's why we less it, so that now we can get the actual value of goods that were sold. The goods that we sell, they are going to cost us. We did not get them for free. They costed us. So we want to compare this amount that we received after selling them. Then we compare with the amount it costed us to acquire them, so that now we can be able to know whether we are making profit or loss. So from the net sales, we less what we refer as the cost of sales. We less what we call the cost of sales, and the cost of sales comprises a number of items, so we normally underline it. It comprises of opening inventory, or stock, put it in the middle column. Opening inventory, put it in the middle column. This is the cost of the opening stock. When we were starting the year, there is that stock that remained the previous year. So the stock that remains this or today, and tomorrow is a new financial year that is starting, the stock that remains today is what I will start with tomorrow. So the cost of that stock that I started with, I add the cost of what we call purchases. Purchases is the additional stock that I brought into the business. This one, it normally requires some adjustment. Purchases, we normally put it there in the first column if it has some adjustments to be made on it. And these adjustments are, to the purchases, we add what we call the carriage inwards. The carriage inwards, you add it. Carriage inwards is what? This is the cost of transporting purchases, in short. Carriage inwards is the cost of transporting the purchases from the supplier to the business. So that cost, because it is purely attached to the purchases, we normally include it to the purchases. So if I buy goods worth 10,000, I incur 1,000 to transport them. Those goods have costed me 11,000, not 10,000. So the cost of transporting purchases is referred as carriage inwards. Sometimes they call it carriage on purchases. Then I less what we call purchases returns. I less what we call purchases returns. In a figure I less, it is normally indicated in brackets. Anything you minus, minusing means you put that figure into bracket. So this is the cost or the price I paid the supplier. Then what I incurred to transport that. Then part of those goods that I purchased but never remained in the business because they were returned back to the supplier, they are known as purchases returns. The value of those goods that were returned, we normally less from the purchases, so that now we can get the actual cost of the items that remained in the business for sale. So the first column, you can realize it is only meant to do an adjustment on purchases. That's why I said in this question, you can work with 2 or 3 columns. 2 columns are going to be applicable if these two, if none of this is given, carriage inwards and purchases returns. If the question does not have them, then we can simply work with the 2 columns. But if purchases requires adjustment, then we need an extra 3rd column for that particular adjustment. So cost of purchasing, cost of transporting minus the cost of what we return gives us the net figure for purchases. Now you put it in the middle column to be in line with the cost of opening stock. So this is the cost of what we added and the cost of what we started with. So if you add the two, it will give you the cost of goods, cost of goods available. Cost of goods available for sale. To the cost of goods available for sale, you less the closing inventory. So this is what we had to sell throughout the year. But by the end of the year, these goods or the value of these goods was not sold. It is still part of the business inventory. So if we had goods for sale worth this, these have not been sold. So what we sold, they costed us what? Let me put some figures for easy understanding. If I had the opening stock of 3,000, then my net purchases is maybe 15,000. So in short, in that period, I had goods worth 18,000 to sell. Or the goods that I had to sell, they had costed me this. But now, when it comes to the end of the year, I realize that there is what we call the closing stock of maybe 4,000. These 4,000, because they have not been sold, I minus from what was available, then I remain with what? This figure of 14,000. Then it simply means that if I have a stock of 4,000 that is not yet sold, then what I sold must have costed me 14,000. What I sold costed me 14,000, and that is what we call cost of sales. What was available minus the unsold, you get the cost of sales. Put it to the last column to be in line with the sales. And remember, this one is less. Remember here we said less cost of sales. So we are supposed to minus from the net sales, we minus the cost of sales. You get a figure here. Either it is going to be gross profit or it is going to be gross loss. If the sales revenue, this is income, is more than what it costed us, then we make a gross profit. But if the cost is more than what we sold, it is a gross loss. So this is the cost of what we sold. So whatever we sold, it costed us this, but we managed to sell them at this. So the difference of what we earned from selling them and what it costed us in acquiring them, it gives us the gross profit or loss. Then to this, we normally add to the gross profit. If the question has, you normally add what we said here, decrease in allowance for doubtful debts. Add it. When it is more than one, you put it there. We also add the discount received. This is what we normally call the other incomes. Discount received. We also have rent receivable or received. Some cases, commission received. These are the other sources the business can generate income from, apart from the selling goods. Apart from buying goods cheaply and selling them at a slightly higher price, you can get income from this source. Add the total, transfer there. The figure you will get here is known as the total income. Total income. Then from the total income, you come and less expenses. Expenses are the other costs. Expenses are the other costs. Apart from the cost of buying the additional stock and the cost of acquiring the fixed assets, other costs the organization is going to make, they are known as expenses. Here, the expenses include things like the discount allowed. When you allow the customer discount, you are losing some money. We have carriage. Carriage outward. We also have increase in allowance for depreciation. Oh, sorry, in allowance for doubtful debts. And then we have the depreciation. And then the others that we know now. We have things like the rent expense, electricity, stationery. All these are expenses. You all capture them there. Then you get the total, transfer the total to the column where we have the total income. Total income minus the total expenses will either give you the net profit either the net profit or net loss. And that will be the end of your statement. Very important to know the flow. Start with the sales minus the sales returns. You get what we call the net sales. From the net sales, you minus the cost of what you sold. That is what we are referring as the cost of sales. It comprises of the opening inventory, the cost of the opening inventory, plus the cost of purchases, the cost of what we added in the business in the course of the year. But note that one, it includes the cost of purchasing plus the cost of carrying them. Then you minus what you returned, it gives you the net figure for purchases. What we started, or the cost of what we started with, plus what we added, it gives us what we have to sell that year altogether. We minus the cost of what was not sold. The difference now gives you the cost of what was sold, the cost of sales. Compare the cost of sales with the net sales. It is either going to give you a gross profit or loss. If the revenue, the sales is higher than the cost, that is a gross profit. If the opposite happens, whereby this one is more than the sales, that is a gross loss. After getting this, you need to go and look out. Are we given the discount received, the rent received, commission received? When you compare the doubtful debts at the beginning and at the end, is it an increase or a decrease? If it is a decrease, that decrease only, it is an income. Add there, add to the gross profit, get the total income. From the total income, less all these other expenses. Those other costs that we are going to incur as a result of running the business. The salaries and wages, insurance, expenses are numerous. They are very many. The repairs and all that, the general expenses, you include them here as given in the question. Any cost, apart from the cost of purchasing the goods, cost of purchasing a fixed asset, then the other costs we normally call them operating expenses. That is it. I want us now to capture the second statement, which is known as the statement of financial position. Just a minute. So the statement of financial position is what we used to call the balance sheet. And its purpose is to measure the financial position of that particular business as at the last day of the year. When the year is coming to an end, as at that last day, what is the financial position? The financial position is the difference between the capital and actually the liabilities and the assets. So capital is normally obtained as the difference between assets and liabilities, and that is actually the position of the business. So basically, this statement tries to find out what are the assets that we own, what are the liabilities that we owe the outsiders, and what is our level of capital at the end of that particular financial year. What goes here, they are actually the sales, the purchases, the expenses. Don't write any asset here. What only we talk about here, it is depreciation on the fixed asset, but the asset itself cannot be recorded here. So at this point, just differentiate those items. The expenses, the revenues, then we have got the sales and the purchases, which is actually the cost of the goods, and the revenue from the sale of the goods. Nothing else. Don't capture a liability here. Don't capture capital here. Don't capture asset here. Those three elements of accounting, they are normally captured in what we call the statement of financial position, or previously known as the balance sheet. So you start by the business name also, as given in the examination question paper. Then you write here statement of financial position as at the date given. It is normally dated as at. Whereas this one is normally dated for the year ended. This one is as at that last day of the financial year. Then you underline your work. Here, we have said we normally deal with three things: assets, capital, liability. So we normally start with the non-current or the fixed assets. This one, because they depreciate, we normally have a column to record their cost, accumulated depreciation, then the difference will give us the net book value. So we normally have three columns to record the non-current assets. What is their cost? How much have they lost? The accumulated depreciation. What is the remaining value? The net book value. So the net book value, it is simply the cost minus accumulated depreciation. We get that. So some of the non-current assets that we can have in the business include land and buildings. We have motor vehicles. We have equipment, machinery, furniture and fittings. also need to be careful not to interfere with the columns for the amounts. So if you are if you have a problem in managing this, you better draw the columns. You better draw the columns. So you put the cost here, you minus the accumulated depreciation, you get the net book value. The vehicles the same. Machinery the same. Cost minus accumulated depreciation gives you the net. You do them like that. Then these two, you no longer require the total. You only need the total for the net book value. What you need is the total for the value of those assets at the end of that year, and that is going to be contained in the column for the net book value for all the fixed assets. To that, you add the value of the current assets. The value of the current assets. Current assets include items like inventory, and use the closing. Use the closing inventory. Closing inventory is the one that is still in the business. The closing inventory is the one that is still in the business. That is what we consider as the asset. Then we have the debtors, also known as the accounts receivable. The accounts receivable. We have things like prepaid. As we said in the end year adjustment, prepaid expenses. That money is still ours. Accrued income. Then we have cash at bank. Then we have cash in hand. All those are current assets. Get the total, transfer them to the other end. The total figure for the current assets plus the net book value of the non-current assets will give us a figure here we call total assets. It will give us a figure we refer as the total assets. Total assets the business has for that duration or that financial year. After that, we go to the section of capital and liabilities. Capital and liabilities. Start with capital. Put the amount in the middle column. To that capital, add net profit. But if it is a loss, you less. Then you less the drawings. Drawings you minus. Remember we said drawings, they are those resources taken from the business for personal use. So they reduce the capital. That's why we are resting, so that we can get the net figure for the capital at the end of that year. Net profit increases the capital amount. The drawings, they reduce, or if it was lost, it is also a reduction. From that, you go to the long term. The long-term liabilities, those debts that we are going to pay after a period exceeding one financial year. And a good example here is normally the bank loan. That is the most commonly example used in the sole trader. After the long-term liabilities, now we go to the current the current liabilities, the creditors or accounts. Creditors or accounts payable. Put it there. We have a bank overdraft. We also have what you call accrued expenses. Prepaid income. Add them, transfer the total here. Figure for capital, long-term liability, and the total for current liabilities will give you total capital and liabilities. And that is the end. That is the end of the format. So from the bookkeeping equation, if you can recall, we said that assets must be equal to capital plus liabilities. And therefore, the figure that you get here should be the same figure that you get there. Yeah? That is how you know whether you have done everything right. What you have here for the total assets should be the same as the figure for the total capital and liabilities, because the accounting equation demands so. If you don't get it right, two things are possible. The obvious or the most common one, you made a mistake somewhere in calculating your net profit here, because your net profit will be transferred here. If it is wrong, it will affect that. The other issue, low layer, but it happens, especially on your papers, the question was not to standard. If the question did not capture the information correctly, it will fail to balance. But anyway, this is how you do it. But the good thing about accounting, we mark entries. We don't mark the final answer. We are not interested with this so much. If the question was having 20 marks, if you put as many correct entries as possible, but this one does not balance, you'll find in that question you have scored 16 out of 20. We mark every correct entry. Even if the net profit was wrong, we shall proceed here. And if everything is right, apart from this net profit, all this will be tick apart from now this one. The others, they will be correct. This one will be correct. This one will be now wrong. Any correct entry is a mark. So don't be discouraged that if it does not balance and fail, it simply means that there's an error somewhere, but just proceed to the next question. Don't waste a lot of time. When you try to locate errors in these questions, they consume a lot of time. They consume a lot of time. And my advice has always been, if you go there and you find that it has not balanced, just proceed to the next question. You can spend even 45 minutes trying to find out where you went wrong. And in that, maybe 45 minutes, you are just looking for 2 marks. You have already earned 18 marks or 16 marks. You are trying to look for 4 marks with 45 minutes. Those 45 minutes can be used somewhere and they earn you like 20 marks. Better you proceed. They are very tiresome when it comes to locating the error. I want us now to go to the document that I shared today, and we try to have a look at it. So can we do question 1 first? Or I do question 2, then I give you question 1, then tomorrow we do question 3 again. Okay, question, let us do question 2. Then on your own free time, try question 1. But question 2 does not have everything that I need. Let me do question 1. Let me do question 1 because it starts from sales. So you are told that the following balances were extracted from the books of accounts of Teller Enterprises as at that first Dec 2017. So we are given the trial balance or the figures from the ledger accounts. Those are the figures that were obtained from the ledger accounts. And then down there is additional information. That information is very key. And anytime you are handling these questions, always start by having a look at them, because they are the ones that now contain the end year adjustment. So we normally say, or we normally start with what we call the workings. The workings. Number 1, we are told that the inventory as at that first Dec 2017, that first Dec 2017 is the year we are preparing these statements. If you look at the prepare, you are told we prepare an income statement for the year ended that 1st December 2017. That 1st December 2017 is the end. So that is the closing inventory. Closing inventory. We are told it is going to be how much? 653,400. Provision for doubtful debts of 5% is to be created. This is number 1. Number 2 is provision for is going to be created. 5%. It is normally 5% of debtors or accounts receivables. Debtors are accounts receivables because those people, part of them, they will.
Madam, which question are we handling?
Sorry?
Which question are we handling?
Question 1.
Okay, thanks.
Question 1. We are dealing with the additional information part. Question 1, additional information. The first one is about closing inventory. That is the figure we shall use when we require now the inventory. The provision for doubtful debts. Provision for doubtful debts is normally on debtors. What is doubtful is what the debtors owe the business. So you use the figure for debtors, and debtors, they are also known as the accounts receivable. I can say they have a value of 2,400,000. And somebody give me that figure. %5 of 2,400,000.
120,000.
120,000. Thank you. You can be able to see, if you look at the trial balance, there is nowhere we have the provision for doubtful debts. But now we are told it is to be created. So this is the first time we are having this allowance on provision. So the whole amount of it, when it is for the first time, the whole amount is normally considered as an increase, because initially there was no provision or the provision was nil. Now that we have created, we consider the whole amount. Then lastly is depreciation on furniture is 20% per annum on cost. Very important. 20% per annum on cost. So the third working is depreciation on furniture. It is going to be 20% on cost. So you just go to your trial balance and find out what is the furniture at cost. Furniture at cost, it is the first figure that we have there, 2,800,000. Just use that cost as given. This one gives us what? 56. 560,000. So not wrong. Like that. But if it was 20% on book value, 2,800,000, we could not have used 2,800,000. We could have used, yes, it could have been 20% times 2,800,000. But this 2,800,000, we minus the provision for depreciation that we are given there as 1,120,000. We could have minus. Remember, the net book value is normally the cost minus the accumulated depreciation. So this depreciation of 1,120,000, it is what the asset has lost from the date of being acquired to the beginning of the year. So as we were starting the year, already it had lost this. Already it had lost this. So we minus this one from the cost so that we get the book value. And we know when it is on reducing balance method, it is supposed to be a percentage on the book value. Yeah? So you note that. But when it is cost, you just use it direct. You multiply the percentage with the cost. And we are done with the adjustments. Then from there now, we can prepare the statements that we are required to prepare here. The first one is an income statement for the year ended at 1st December 2017. You'll come here, capture the name of the business, Teller Enterprises. Then you say income statement for the year ended that 1st Dec 2017. For the year ended that 1st Dec 2017, underline your heading like that. In this question, we don't have carriage inwards, but we have return outwards. Actually, we shall need 3 columns like that. So we start with the sales. The sales figure is 5,744,500. That is the sales figure. Once you have written the sales figure, you need to consider whether we have return inwards. You need to find out, do we have return inwards or known as sales returns? From my end, I cannot see. We don't have it. When we don't have it, then there was no any return. So what we sold was actually our actual sales. There were no returns. From that, now you less the cost of sales. Start with the opening inventory. What is the value of goods that we started with? Let me put this one to guide me. The opening inventory, you will always find it in the trial balance. You will find it in the trial balance, but the closing inventory, you will find it in the additional information. So the opening inventory is 300,000. Put it in the middle column as we agreed. Then you'll come here and say, to that opening stock, we are supposed to add the purchases. But these purchases, because it requires some adjustments, we put it in the middle column first, 2 million to 1,000. And then the only adjustments that we can make here, it is on return outwards. There is no carriage inwards. There is no carriage inwards, but we are given return outwards, which we are supposed to subtract what was bought and returned less. Return outwards, they are valued at 5,200. Somebody to assist me with doing that. 2 million to 1,000 minus 5,200. Somebody, and nobody has an answer. We are getting the difference between these two, the purchases and what was returned.
2,100,000
2,100,000
50,800.
Come again, please.
2,150,800.
800.
Like that?
50, 800.
800.
800.
Yes, 100.
Yes, 800.
Okay, thank you. Then that is the net figure for the purchases. What we actually purchased and remained in our business is that. So can you add this plus this so that now we can get the cost of goods available? Available for sale. 2 million for 50,800, if I'm not wrong.
Yes, that's correct.
Yes. Then to that, we less what was never sold, less closing inventory. Additional information number 1, 653,400. The figure that we shall get there is what we refer as the cost of sales. Can you do the subtraction?
$1,797,400.
1,997,400.
Yes.
That one is supposed to be in line with the net sales so that we can rest to realize or to get the gross. The gross profit. You less it, huh? This sales minus that one.
$394,721.00.
394.
721.00.
That is our gross profit. Then to that, if there is any other source of income, let's see, we said the decrease in provision for doubtful debts, rent received, commission received, discount received. Do we have any of those? With the provision, it was an increase. That one, we ruled it out. But I can see we have got the discount received. We add discount received. And it is how much? 30,000. So that we can get the total income to be 000,017,793. That is going to be our total income. Then from the total income, we come and now less the other operating expenses. Other operating expenses. One, we have got the increase in provision for doubtful debts. Provision. Because it is the first time we are creating this provision, we assume that initially the provision was 0, but now we have increased it to 120,000. We consider the whole of it as expense. Then we have depreciation on furniture. We calculated and found it to be 560,000. That is what we had on the additional information. Then we go to our trial balance and locate more expenses if we have any. We have the discount allowed. That is an expense of 53,100. General expenses. $1 million. Somebody to add for me that.
$2,161,800.
Sorry?
2 million
Yes.
161
160.
61 800.
Okay, those are now the total expenses. The total income minus the total expenses will give us what we call the net profit. Because the income is more. Just a minute.
1 million
1,815,000.
815. Yes. 815. 300. 300.
Thank you. Higher. That is the end of the income statement. The moment you have arrived at the gross profit, the net profit or the net loss, that is what the question was requiring. And you have done your work. The next part now is to do the statement of financial position. The statement of financial position. And you can do it. So this is a teller. Statement of financial position as at so we need a column to record the cost of the non-current assets, accumulated depreciation, net book value. We need those three for the non-current. Assets. And the non-current assets that we had in this business was furniture. Whose cost was 2,800,000. But when you go to accumulated depreciation, when you have already been given the provision for depreciation, if you look at the second item from the top, we are given provision for depreciation on furniture. And that one I told you, that is what the furniture has lost up to the beginning of this financial year. And then in this financial year, it has lost what we have done there as working. Yeah? So it has lost 120,000 this year, and then it had already lost 1,120,000. So you need to add the two so that you can get the total depreciation amount to date. As at this date, how much has it lost? It has lost, therefore, 1,240,000. You add the two. And now the cost minus the accumulated depreciation will give you its current value as at this date.
Living.
Which is 1 million. $1,560,000, and we did not have any other non-current asset. So for this, we are not interested with those two columns. Our interest is on the net book value. So you'll come here and then capture the current assets, where we shall record the inventory. And I insisted, when it comes to inventory, don't confuse. Always use the closing inventory. 653,400. 653,400. Then we have got the accounts receivables. Which are actually the debtors. The accounts receivables, we are told, or we are given there, was 2,400,000. This one requires some adjustment. 2,400,000. We minus what is doubtful at the end. Sorry. 2,400,000. This is what the debtors were owing the business. We minus the provision. Remember, the provision is what we are doubting. We are doubting 120,000 will not be received. This 120,000, you left it from here, you'll find that what we are sure of receiving is going to be 2,280,000. Then, do we have any other assets? We have got cash in hand. There is cash. And the figure for cash is 301. 301,100. I think those are the only current assets we have. Can you do for me the addition? So that now we can get the total figure for the add for me these figures.
3 million.
3 millions.
234.
Sorry, 3 million.
234.
Yes.
234. 500.
500.
Yes.
Then this is the figure for the total current assets. Add to the net book value of the non-current.
$4,794,000. 4,794,94500.
Thank you. That is now the figure for the total assets. That is the figure for the total assets. Then we shall go to the section of capital. Where we shall start with the capital. The capital for the business was 1,139,000. Then we add the net profit that we got from the income statement, 1,815,300. Then do we have drawings? Drawings, whenever you see drawings, just know it is going to less capital. So it is not there. So if you add these two, what is the end figure or the final figure for capital in that year?
$2,000,000. 954.
900 and
954. 954 300.
thank you. Then I can see here the bank loan, so we don't have any long-term liability. There's no bank loan. Therefore, what we have then is the current liabilities. And here we have the accounts payable. The accounts payable is the same as the creditors. The accounts payable is the same as the creditors, and we are given 1,400,200. And actually, it's like it is the only current liability that we have. So there is no need of putting here and here because there is nothing else to add it to. We just put it direct there. 1,400,000.
$4 million.
4 millions.
354.
Sorry, come again.
354.
4 million.
354. 354. 500.
Kuna shida kidogo hapa. Our figures are not balancing. The total capital and liabilities and the total assets, they are supposed to be the same.
29.
Where did we go wrong? Can you get the difference? This minus this, what is the difference?
For 40,000.
For 40,000. $440,000. I can't see anything that we have not included worth that much. Did we do any wrong addition somewhere or subtraction? Let me check. I can't see any arithmetic error. That is now the problem. Ikikataa kubalance kutafuta makosa, it takes time. And you might find it in the question that had issues. Huh?
Mwalimu,
Yes,
I think I've found an error
yes,
on this net book value.
yes,
We indicated as 1,560,000,
yes,
and you had said, I think net book value is the cost minus accumulated
yes. This
depreciation. So when you do that cost minus the
accumulated.
yes, there's this figure that we've been given here on the question,
Yes,
1,120,000.
yes,
So you add it, and then we were told the depreciation is 20% per annum on cost. So this depreciation we have given is as at January, and now we are doing for the year.
yes.
So for the year, we would have the furniture will have depreciated by 560,000.
Oh,
So when you add that to
oh.
the one that you, at the beginning of the year, you get
I got it.
1,680,000.
Actually, I'm the one who did the mistake. You see what I did? Huh? What I did, let me just show you. I took a wrong figure. Instead of taking the provision for depreciation, which was 560, I took 120. Yeah? So I added this 120 to the 1120 that we had there. So I added 120 instead of adding 560. That is where the issue was actually.
So when you add it, balance it, it's similar, the figure.
Oh. Okay. Now I see.
So the net book value should read 1,680,000.
1 million?
What is that?
Yes, 1,680,000. That is the accumulated depreciation. If you add 1120,000 to 560, that was actually the issue. Yes. Sasa itakuwa 2,800,000 minus this.
1,120,000.
1 million?
1,120,000.
Then you add it to this. Yes, now it balances. You can see now how you can make a small error and then it can trouble you a lot. That is it. That is it. But you realize that if it was an exam and we do that error, we could have missed this. We could have missed this too, but all the others could have been correct. So it requires a lot of accuracy. It requires a lot of accuracy. So I want you to try question 2. Question 2 is simplified for you in the sense that they have done it all the way to the gross profit. The question does not provide you with the sales, opening stock, and all that. It has been giving you, or it has given you the gross profit. You have been provided with the gross profit. Actually, now you are supposed to work from here downwards. You have already been given the gross profit. To that gross profit, you find out whether you have got any income, which I can see there is none. So you just less the gross profit. You come here and you say less expenses, you less all the expenses that you are given there, but after incorporating the additional information, have the workings, get all the expenses minus from the gross profit. Either you get the gross profit, the net profit, or the net loss. And then you prepare the statement of financial position. And then tomorrow we shall revisit on it. That's where I want us to stop today.
Thank you, Mwalimu.
Asante sana.
So
Thank you.
with that, I wish you a blessed evening.
Thank you.
And you too, Mwalimu.
Okay.
Thank you.
Thank you.
Karibu, karibu.